All right, well, greetings everybody. Welcome to our special edition tonight, the April 6th, 2020 edition of whatever Ken and I feel like talking about. I'm joined here by my friend Ken Kavula. Say hello, Ken.
Hello, how are you all? So happy to be with you. If you're as bored as I am sitting at home looking at the walls, write me questions. I'll respond. I'm find I'm answering a lot of questions on the computer nowadays. So
Yeah, I'm also experiencing quite a few too. My name is Mark Robertson, founder and managing partner of Manifest Investing, and we're just thrilled to spend a few minutes tonight talking about some subjects that are very near and dear to our heart. Now, the cover slide, I think that's a cool picture. It's actually a picture of the Atlantic Bridge on the edge of what I believe is a fjord in Norway. It's obviously the right angle to capture that at, and you got to wonder what the other side looks like, and that's kind of what we're here to talk about tonight. We talk about chasms and abysses and challenging moments in the stock market, and whatever's on the other side of that bridge might qualify. But you know what I think might be on the other side of that bridge, Ken?
well, Mark, since you know, I'm not even going to hazard a guess because I'll be wrong, but I'm hoping it's beautiful, a beautiful village.
Well, see, I'm thinking it could be Punxsutawney,
Oh, okay.
or maybe even San Antonio. I mean, the roads to San Antonio and Punxsutawney have to be there. So
There's a story behind Punxsutawney, folks. Mark and I drove to Harrisburg, Pennsylvania for a session with the Central Pennsylvania people about a year and a half ago or so. And on our way back, the rain was coming down as if God were angry with us. And of course, I'm the one driving on the Pennsylvania Turnpike, which is not the best of roads in a lot of places. And Mark starts seeing signs for Punxsutawney. And in the driving rain with my hands at 10 and 2, he's trying to get me to turn off the road and go to Punxsutawney to see one of his groundhogs. So I've been blessed with this Punxsutawney stuff ever since. So that's what he's talking about. I just say, Mark, you need to get in the car with your wife and go to Punxsutawney, okay?
all right. And one thing I do want to point out is everybody else is putting face masks on their pictures on their presentations today. I avoided that because we have a no costumes policy.
Thank you. Thank you.
I was going to put one on the night though.
All right.
All right, just real quickly, we are going to talk about real companies in real time. No investment recommendation whatsoever is intended. This is about education. It's about the way we see the world of investing in a very unique, I think dramatically simple way once you get your arms around it. And we deploy sleep at night investing. We're going to talk about how we do that a little bit tonight using specific companies. They are for illustration and demonstration only. Do your own homework. We'll try to mention if we own any of the stocks that we talk about. If you'd like any future reminders, we do host a monthly webcast called the Roundtable, the last Thursday evening of every month. If you'd like to have reminders about these type of events, you can email nkavula1@comcast.net. And then if you have any follow-up Q&A or would like copies of slides, you can send an email to me, Mark R. at manifestinvesting.com. We'd be happy to share copies of these slides or entertain any follow-up questions. Any other comments or questions, Ken?
Well, Mark, I'm just going to jump in and tell you that Mary Wrench is telling you that the knight already has a face mask on.
There you go. But I don't think it would be N95 compliant, though, if memory serves. No.
That's kind of large holes. Stuff's going to get right through that,
Yeah,
you know?
Virus is smaller than that. Well,
Yeah.
before we get underway tonight, I thought we would actually spend a moment with the 50th wedding anniversary for the Kavulas and apparently two of our other attendees, the Gleasons and Teresa and her husband. But happy anniversary, guys. There's a picture of Ken and Natalie at one of the national conventions. And 50 years is pretty special, and we're definitely going to have to go out for something more than Tim Hortons donuts, although I'm sure they were really great donuts. So everybody raise a glass, a cyber glass, in the direction of mid-Michigan, and wish the Kavulas the best. You guys are awesome.
Thank you, Mark. It's greatly appreciated.
All right, so let's talk about what we're here to talk about tonight, cartography, and basically trying to map out some expectations for what might lie ahead. We're going to go through a few things, talk about comparisons to 12 years ago, capitalize on some Groundhog fervor from our stock picking contest and some interesting moments. I want to talk a little bit about Tin Cup tenacity. That's our model portfolio that stays 100% fully invested, even in these dramatic moments like we're going through right now. Some of you are familiar with a little exercise I did on the throwing of towels. It's just a very powerful reminder about investing regularly. And we also wanted to share the recession watch that we're doing at Manifest Invested. We shared at the most recent roundtable. Ken has some thoughts on stock studies, stock selection guides that are triggered invalid by the rather dramatic price activity to the downside here lately, using Alta as a case study. Then we'll talk about toilet paper and Clorox for a few minutes and try to leave a little bit of time for Q&A if we can. And there on the left, you can see there's the proof that you can survive without toilet paper. It's a 3-hour tour that actually went for several seasons on TV. All right, so let's go and get underway. The graph you're looking at is one of our favorites at Manifest Investing. It's actually the value line arithmetic average graphed over time. The green bars on the bottom are, if you added up the prices of all the companies in the value line standard edition and kept track of them over time, you will notice that the stock price has actually been fairly significantly depressed here of late. And you can see that going back to 2008, 2009, there's this little hole in here which we will actually think of as a chasm. There's a chasm which was actually pretty painful back at the time. The blue is just simply a mathematical trend. We like that blue line. We think it's a reminder that better days are probably ahead. And probably most importantly, that red line represents the average return forecast, very much like if you had done a stock selection guide on every single company every quarter going all the way back to 1999. In those special moments that you see, and I say special in terms of it was kind of a teeth gritting tough moment back in late 2008, early 2009, the average return forecast just simply went off the charts. And we actually are back there again. I do find it interesting, Ken, that we're actually already starting to see the analysts make some corrections back down to the downside here in the most recent report. But again, just thinking in terms of comparing, I think the stuff that happened 12 years ago, it was certainly different. It was certainly devastating, and seemed to be a little more man-made and a little more that was in the making. There was a lot of time in the making of leading to that downfall. How do you think the two time periods compare, Ken?
I felt fear back then, Mark, and I feel fear right now as well, but it's really a different kind of fear. This particular fear, I'm a mathematician and a scientist by training, and that's what I taught for all those years that I taught, and I want to believe, and I do believe solidly that our science people are going to solve this, and we're going to look back on it, and we're going to say to ourselves that we were able to come together, do what had to be done, and then find a solution to a very difficult problem. I was never sure, because I didn't understand what the problems were in many cases back in 2008-9. I was never sure that we were going to find a solution to the problems that were plaguing the banks. It scared the living daylights out of me when I'm going to forget the name of the Lehman Brothers. That's it. When Lehman Brothers went bankrupt, and I could just see the rest of the iconic Wall Street firms falling in line and going bankrupt one after the other, and bringing down the entire financial system and the entire economy all at once. I think the potential's still there for us to have some serious problems. We've ground the economy to a quick stop. If you can think back 4 or 5 weeks, this was just kind of a glimmer at that point, except to maybe the people in Seattle. And now we're all staying at home and doing things that I never thought that we would be forced to do. So there's still fear, but on this one I have great faith, and I think it's based on what I know about science and what I know about the way that you deal with scientific problems. My faith is we're going to solve this, and it's going to be solved sooner rather than later. That's kind of a rambling answer to a pretty short question, Mark.
Yeah, but it's worthy, and our task here tonight is to try to give some at least guesses or consider judgments about how wide will this chasm be. And I echo and reinforce a lot of what you said. Back in that 2008, 2009 timeframe, there were actually moments when Hugh McManus and I were comparing notes that the magnitude of the credit default swaps and the stuff that could have happened is just almost beyond the imagination. And this time around, Hugh's message is, we're going to render this virus extinct, and we're going to do it soon. He's speaking from the realm of being a pharmaceutical scientist, so it's kind of interesting to hear him talking that way. And so he's, and we've quoted him a couple of times at Manifest Investing. He's saying, isn't it great that we get to do this one more time during our lifetime, find some really neat stuff on sale. And again, if you're getting a paycheck and investing for the long term, yeah, that's true. If you're protecting a nest egg, probably not quite as much fun, but interesting days ahead of us. All right, so let's go ahead and talk about 12 years ago, just to put everybody in a frame of mind. I want everybody to take a deep breath. Think back to that time frame back in early 2009. We had basically been in a tough situation since Halloween 2007. So I went back and I looked up what was the #1 song at the time back in March 2009. Turns out it was Kelly Clarkson with "My Life Would Suck Without You." I remember the song. I mean, I don't remember the picture of Kelly. I like Kelly Clarkson. And then there was the most popular movie at the time was Frequently Asked Questions About Time Travel. I am not making this up. That was the title of the movie, and it was the top ranked movie back in that quarter of 2009 and on TV. And I don't watch a lot of TV, but I watch enough. I've never even heard of the TV series Trust Me. And Ken, I don't think those are among your all-time favorites either, are they?
Well, Mark, I don't know the song. I definitely did not see the movie, and I've never heard of this TV program. So I'm just old, So
usually, like you could do a Jeremiah was a bullfrog or something would actually trigger, a memory. Like back when you got married, Ken, it was probably what would have been a good song 50 years ago.
Oh, The Association, Chicago.
Yeah.
Those were really good groups, and the song Cherish, things like that back in that time frame.
Yeah.
I can remember those.
The golden age of music.
Yeah.
So we're going to come back full circle to this.
Whenever you're 19 or 20, Mark, it's the golden age of music. That's true. That's what it was. So
we had this really nasty moment back in 2008 where the stock prices went down. And what I'm going to draw your attention to, we're going to come back full circle to this. Stocks were just getting hammered and were what is thought of as potentially oversold. Back from the end of 2008 into early 2009, it really was only a few months, but it did feel kind of painful. And we'll come back and talk about that a little bit. But what I would like to take us back to is, Ken, do you remember those morning phone calls back in 2008 and 2009?
Well,
And
Mark and I
companies
had
we
been
talked about?
friends for, yeah, Mark and I had been friends at that point for 4 or 5 years, and I felt very comfortable calling him up and talking about what was happening on my stock selection guides. And I was doing SSGs left and right and up and down looking for stocks. Natalie and I had just had a large sum of money released from our retirement accounts. It had been frozen because of some problems with the 403B, and it had just been released to us. And I was trying to get it invested into a good, solid set of portfolios, 2 IRAs that would see us through our 50th wedding anniversary.
You made it.
Luckily I made it, and those portfolios are still going strong. But I was calling Mark on a regular basis. Mark, do you believe what this SSG is saying? And he would sit and ponder and do some of the same figuring I was doing, and then finally would say, well, he says, he would say, I'm not sure I believe it, but I'm getting the same numbers you are. So we were doing that all over the place. These are the heavy hogs from the Groundhog competition, aren't they, Mark?
Yep. Yeah, from February 2009. So $100 would have been invested into each one of these 16 positions back in the teeth of that Kelly Clarkson song. When Kelly was singing on the radio, these were the stocks that were true community favorites amongst our wonderful group of investors out there. So the next question is, again, what happened over the next 10 years? Let's talk about 10 years from, again, March 9th, which many people see as the beginning of the bull market and the end of all the pain and agony, and 10 years later. And these have been arranged pretty much in the order that they were on the previous slide. And I just want you to scan from top to bottom those returns.
Yeah, what I want to remind you in the audience as you're scanning is that first column, that $100 is now. If the number is 200 or better, then you were growing at about half, 15%. And if the number is 400 or better, you're growing at 15% or better, which has been the long-time goal of many of us that have been in investment clubs for over time. So when you see a Sigma Designs going from $100 to $22.67 in 10 years, or for that matter, common stocks like CSX, Microsoft, and Aflac all going from $100 to close to $1,000 a share, you know that our community was doing a good job of choosing. I'm looking only at 3 or 4 companies that didn't hit that $400 or better, and only one real, in my mind, disaster, and that was this Next Gen Healthcare. And I'm not quite certain what happened there, but
That's
it
the
certainly
former Quality
wasn't very
Systems, Ken.
pretty. Pardon?
That's the former Quality Systems, and they had some tough moments.
Yep, it certainly wasn't pretty when it finished, although it did make money from 9 to 19, but not enough for us to continue holding the investment. Buffalo Wild Wings, you'll remember, was purchased and taken private, and Navalier Fundamental was taken private. And Navalier Fundamental, you can't, you don't have any dollar figures for a lot of the stuff on it to deal with, but. Going from 100 to where a lot of these finished up certainly is a testament to our stock pickers in that Groundhog contest.
Absolutely. So, I mean, a market that went up 10 or 11% per year, this group of stocks went up 21.2% as a group. And that's doing some pretty good investing. So, again, the common amongst these stocks are the same thing that we look for every day. And Ken and I are going to tell you, you don't want to stop doing that. You want high quality companies with excellent management. So you want the blue, you want high quality, and you want outsized, without getting too greedy in most cases, long-term return forecasts, projected annual return on the right-hand column, and just keep doing it. All right, and just as a quick reminder, I like to pull this one out. This is our Tin Cup model portfolio. It's actually a qualified plan or a 401k demonstration of investing the maximum amount into a 401k starting in 1995. And we publish these every month. You can see that we actually approached $2.5 million just a few months ago, and we've gone for a pretty nasty ride here lately. But again, I want to draw your attention back to that 2008-2009 time frame. It didn't feel good. It felt actually pretty painful, and we were gnashing our teeth. We were worried about that hydrogen bomb with default swaps and everything else that was going on in the market. But stayed fully invested. This portfolio is always 100% fully invested in some pretty good looking companies, better companies at better prices. And what was interesting is the portfolio recovered in just a few short months, starting back in that March 2009 timeframe. And so I think we can hope for something similar from a group of fairly decent stocks that's taken a pretty good hit in the last few months. And in fact, checking tonight, I think we're probably back upwards toward 2 million. But the reminder is, it is possible to stay fully invested. You got to ride up the storm a little bit every once in a while. Most investors, the average investor on the street cannot even contemplate or understand our ability to wade through these storms. Most regulators can't. I'll tell you, I have sat in rooms at after midnight with SEC enforcement people that just can't believe that people can actually grit their teeth and get through these moments. And our community has demonstrated an ability to do that. And this shows you that you don't even have to worry about asset allocation. We think of asset allocation as a form of market timing. Instead, find good companies, buy them when they're on sale. So interesting stuff. And then there's another powerful reminder. Again, in times like this, you can have markets which remain flat. Some of you remember the lost decade of the first 10 years after the year 2000. Well, here we're looking back at the 1970s. And much like we've had with the Russians and Saudis fighting over the oil, we have a disruption in the energy and petroleum markets right now. Well, we had that back then also. We had, odd numbered days of filling up your gas tank. Remember those days, Ken?
Well, I wasn't doing a lot of investing back in this time period, Mark, in the 70s at least.
You were doing some driving though.
I was, but not worrying as much about my gas tank. I fretted more. I was driving a Mustang, and I fretted more over the fact that it would only allow me to go 55 miles per hour on the expressways than I did about the actual price of the gasoline. I didn't have enough money to actually travel very far, so we didn't.
55. Oh, that's when they stuck us with the 55. Well, again, the point that many people will make is that that flat market was nasty to investors. But again, if you're getting a paycheck, if you're in an investment club, if you're putting in money monthly, you just invest regularly. Because again, that flat spot from 73 to 82, the market went up 2% per year over that time frame. But if you were investing in decent stocks, investing regularly, rule number one, you actually netted, and this is just investing in the Dow Jones, 11.5%. So there's a massive difference between investing regularly and taking care of a lump sum and reaping those benefits. I also found it very interesting that back in that time frame, some of the best stocks ever chosen for Better Investing magazine were chosen during that time frame. And in fact, the all-time best selection for the stock to study was limited brands back in, I believe, 1982. One of the really top ones was Coca-Cola back in 1974. So you can grab that article, a little more detail at that. That's our blog at the bottom, expectingalpha.com, and get a little more information. But again, investing regularly is the key. And I have to confess, I am scrambling to put together cash because I'm generally pretty fully invested, and I'm trying to scrape together some cash to take advantage of opportunities. Any other thoughts on that, Ken, before we talk recession?
No, but this looks like a pretty interesting graph.
All right, this one is from ECRI, which is the Economic Cycle Research Institute, which is kind of amazing to me that we have an institute dedicated to cyclical economic stuff. And what this one is basically showing is, if you look on the far right-hand side, is we're in one of those moments. Again, much like the one we showed for the value line average, these guys are basically saying they base theirs on GDP growth and that type of stuff. They say that a recession is almost unavoidable at this point. So I thought it might be something we dig into and talk about. What does it mean to us in our community of investing? And this is one of our favorite themes. What you're looking at here is a stock selection guide done back several years ago to do the thing with pick one side or the other. And many of you have already heard this story, so we can't continue to do this. But the short version of the story is it's the same company. The difference is the display on the right includes analyst expectations for the next 1 or 2 years in the formation of the visual analysis. So I think mostly everybody here, if not everybody here, believes that over the long term, stock prices are going to follow earnings. So what if we really believe that and we watch it happen day in and day out, what's going to happen to the stock price of this company? And absolutely, it's going to basically get cratered as this company enters what proved to be kind of a depression, kind of a major recession for this home builder, in fact. So again, we think that looking forward at the estimates is a very important part of doing this. We used our Robin Williams, Old Captain, My Captain, as part of this story, and I would encourage anybody who wants to understand this notion of keeping, placing a little more emphasis on the head. Ken was just talking about tooling down the highway in his Mustang. It's important to pay just as much attention to what's in front of you. Also, you can grab a copy of the article and take a look there at Manifest. So what we're going to do is go through a series of about 6 slides. We did this at the roundtable last week. We want to repeat this again because we think it's so important. What you're looking at is that same type of information that you saw here. And now we're talking about the 1,400 industrial. We've left out the asset-based financial companies. We're looking at the median or average of the net margins for the 1,400 industrial companies. So what you see here is from the end of the third quarter in 2019. And what we want to draw your attention to is, things are going pretty good. The long-term trend, based on the blue line, is looking pretty solid. The numbers for 18 and 19 was up in 8.5 range. And you can see that the other numbers were up in that 9 to 10% range for the next couple of years ahead. And we want to draw your attention to the fact that the end of that blue line is right around 9% for the long-term trend. Anything else you wanted to reinforce there, Ken?
No, you've done a nice job, Mark. And again, folks, this is what it looked like on September 6, 2019. That'll be important as you watch the next slides.
Okay, so we're going to just kind of sequence through. We're jumping several months here now to basically the end of the first couple of months in 2020. And what I've depicted is, again, that same information, but at this point in time, we had actually lost what is shown in the yellow bars. We'd actually receded or compressed for 2019 and 2020. So, again, in the fourth quarter of 2019 and the first part of the first quarter in 2020, this is before any of the virus stuff that's going on right now. We actually had a basic overall weakening of the value line 1,400 industrial companies, both for the 2019 forecast and the 2020 forecast. So that was March 12th. Fast forward just a couple of days, and you can see the trend continuing. We're monitoring this on basically a daily basis now at Manifest Investing. The number is now down to 7, and you can see that the number for 2020 is continuing to compress. So then 1 week later, Same thing, 2019, the actual numbers are coming in. They're coming in closer to 7%. And again, that number for 2020 has begun to compress. Notice that the scale is actually beginning to change over here on the y-axis. Again, fast forward another week, same situation. We're down around a little bit north of 7%, but notice that this number, the forecast for 2020, is continuing to compress. And again, the overall trend is getting deflected downward.
We should remind people, Mark, that the end of that blue line when we started this sequence of slides was up around 9%.
Yep, just going back a couple slides, you can see 9%, and it's you might think of it as almost sliding down. So again, think about what it's saying about this group of companies, all these companies. Well, this is from today. So you can see the recession back in 2008, 2009. You can see that the number for 2020, again, these are the analyst estimates, has now actually dropped so far that it is very close to the 2019 actuals. I mean, keep in mind that number started just a few weeks ago up here. So that's all gone away. And we're seeing quite a deflection. What does that mean to us? It means a couple of things. The first thing is all of the stock selection guides, depending on how permanent this damage is, and I think it's there's some permanence of this. It's not just stress, it's a little bit of strain. Some of it's going to stick, but you basically have seen a reduction from 9% on average to 8% on average. So as you're doing your preferred procedures, you might want to consider being a little bit more conservative with your profitability projections. The other thing that it's telling us is that I think of that yellow line as kind of a tipping point. As we dip below that yellow line back in the really tough period back here, that's when things got a little bit ugly. When you break through that yellow line, I think the recession kicks into higher gear. And the amount that it dips below that yellow line will tell you a lot about how deep and how wide the recession will be. So we're going to be watching that very closely because there's a pretty good chance that we're going to see the number for 2020 actually dip below that yellow line. So it's just a data-driven look at what actually happens. Again, think about what's actually happening to your stock selection guides, the mechanics.
I'd like to remind people, Mark, that as you put this chart together, the numbers that are making up the 2019 bar, those have already happened now, and those are being reported. In fact, we probably have 80 or 85% of the companies already finished reporting their last quarter of 2019. So that bar is almost frozen at this point. But the 2020 bar, very few companies have reported first quarter 2020 yet. So that bar right there is a work in progress, and there's very little work done so far on that bar. Most of it is made up of estimates and guesstimates, and most of it is coming from an analyst community that, believe me, is as confused as most of us are at the present time.
Yeah, there's a lot of uncertainty in the numbers. We'll talk a little bit about that here in a few minutes. All right, so it's nothing to sneeze at. It's just something to be aware of and factor into your overall studies. So with that, one of the questions that we received from some of the participants following the roundtable dealt with stock studies being triggered. So Ken wanted to spend a couple of moments discussing what happens when basically the current stock price takes out the low price. So Ken, I think we need to switch control to you.
Can you make me presenter, Mark, or you want me to do it?
I think I can change presenter to you. You can get ready. Okay, take it away.
Okay. And I'm using the Better Investing SSG Plus. I hope most of you in the audience are familiar with it. And I hope many of you are using this tool that is constantly being made better and better and better. I had somebody in one of my investment clubs ask me about this broken SSG, and that was the term that they used. My SSG is broken. How do I fix it? And I'm not sure that fixing is the correct word, but let me tell you how I'm approaching SSGs during this very difficult time. You're looking at the SSG exactly the way it is for the Mid-Michigan Model Investment Club. This is the judgments that we've decided on as a club, and these judgments have been in place now, probably for 6, 9, maybe even 12 months. And the question has arisen, when you use the judgments that we've been using, you end up with an invalid SSG. And I'm going to try to make that a little bit smaller. So there it is. It comes on to the whole screen now. You end up with an invalid SSG. And I guess the question when you have an invalid SSG is what's making it invalid? And then what do you do in a situation like that? Well, I'm going to suggest a few things. Number one, I'm going to suggest that the analyst estimates that you see in the tool, or that you might read in Value Line, or that you might read on the internet, or you might get from CFRA, or you might get from a source from your broker, or a lot of other places, I'm going to suggest that the analyst estimates are just as confused about what's going to happen this year and next year as you are. The analysts are just now beginning to grapple with the fact that we've completely shut down some companies. Ulta Beauty, and that's the SSG we're doing right now, Ulta is one of them. Ulta has been growing based on store growth. They've been growing their stores by 15, 16% for a fair number of years. Plus their in-store sales have been growing fairly healthy, anywhere from 3 to 4 to 4.5%. And that's given them a really healthy growth rate going forward. You'll notice that my club has said, we're only going to expect that you hit growth rates of 10% because that's going to give us an extremely conservative SSG based on what's been happening in the last number of years. The 10-year growth rate for sales has been 10, for earnings has been almost 29, and we're deciding 10. When I look at the preferred procedure, I notice that a 10% gives me a 6.4. And folks, on the preferred procedure, I've done exactly as Mark suggests that you might want to do. I've looked at the pre-tax profit and I've lowered it a little bit from where the average might be. The 5-year average of pre-tax profit has been 13%, and I've chosen around 12% going forward. Now, I certainly wouldn't fault you if you chose to go a little bit lower than that. I don't want you to go down to 5 or 4 because then you reach a point where you might as well keep your money in under the mattress. But I do want you to be a little bit conservative. We know the stores are closed. We don't know for how long. We're hoping that within the next month or 6 weeks, things will start to open up again and people will start to revert to some of their older habits. So we'll just have to wait and see. Tax rates. Here's tax rates, and the most recent tax rate for Ulta was 22%. That's with the new tax law. So I am going to use the 22.1% for taxes for Ulta. And then we have to decide what's going to happen with shares. I've noticed that shares are moving downward ever so slightly from about 65 million in 2014 to about 58 million in 2019. I am going to use the current number of shares in the preferred procedure of 57.2. That's the default. and I'm going to end up with a preferred procedure that matches pretty closely my sales growth. I'm very comfortable when that happens, so I'm going to use 10% for my EPS growth rate. And I think these are extremely conservative numbers. I'm going to go to the back right now. And most of you know that when I do an SSG, my choice for low price is usually based on 4BA. And that's where you choose a PE, a low PE, a low average PE. And that's where you use the most recent earnings per share number as the default, and you end up with a low price. I think this is a time where you might choose the recent market low. The Ulta has gone down in the last month to as low as $124. So I'm going to use that $124 as the low price for Ulta. And that's suddenly going to give me an SSG that is no longer invalid. Now, when the market resumes normalcy, when I can depend on evaluating a company using fundamental data and come up with conclusions that make real sense to me, then I will stop using this low price and I will go back to my selection based on the low average PE. But right now, that selection suggests that the low price should be around $206. And if you'll notice, that was using a low PE average of 17, and 17's not even on the historic list. It was using a high of 28, and 28's not even on the historic high list. So I was trimming these. My club was trimming these already, but I'm going to switch to this other low price based on the recent severe market low of $124. I don't think it's rational for a company to move in a range of $368, that's the 52-week high, to $124, that's the 52-week low, without something really serious happening to the fundamentals of the company. And folks, for the life of me, I think Ulta is the same story today than it was a month ago or 2 months ago or 3 months ago. I'm looking for stocks that might be very volatile in the short term because of the industry that they happen to be in, but that I think have significant growth prospects going forward. This is a retailer, and I think it's popular to say right now that the world is going to be reduced to Amazon, Walmart, Costco, and Target. I'm not so sure that's going to happen. And I'm betting that this stock and stocks like it are going to have a niche for a long time, and that people are going to buy things from people like this for a long while. Using that low price puts me in a buy zone, gives me a stock with a suitable, for my purposes, upside downside, and gives me par values that are extremely close, and I'll show you this real quickly, that are extremely close to the kind of par values that come from oh, come on, let me get to
Ticker's down at the bottom of the page, Ken,
because I have a wide screen. Okay.
Yeah. While he's pulling that, I'll go ahead.
Yeah, and they're extremely close to where Ulta is today. Now, Ulta is 15%. These are based on analyst consensus numbers. My SSG is 18% based on my judgments. I think those two numbers are close enough to call it a tie. If you're concerned still that this is showing too high, even with these much lowered expectations, then you can always do the artificial things, which are to artificially lower this PE somewhere down to 12 or 13 to present and I'm going to put this picture up, to present a zoning that has a longer bar and therefore gives you a little bit less par that you're going to have rather than the one that I have. I'm pleased with this thought situation, this thought process that I went through, and I think that it solves the issue of this broken SSG. This model club had 6 broken SSGs. I think that's just indicating that we were in a hyper situation where we needed to consider a really different low price, and that our traditional rule of thumb, which was picking a low price to begin with, at least 20% beneath the closing price, I think that needed to be reconsidered when the closing price ended up being $124 on one of the days. So that's what I wanted to kind of present to you this evening. We're going to have a ticker talk in a week and a half, and Ann Cuniaz, Mary and Michelle out of the Silicon Valley chapter out in California, and myself are going to spend an entire hour talking about SSGs and what do you do with your SSGs during uncertain times like this. We'll have a number of tips and tricks, and we'll have a number of things that we would like you to consider. The biggest thing to consider, however, is that this tool was never meant to be a black box. That means there are no correct set of numbers that you fill in and get the right answer. This is an aid to your judgment. That's all it is. And I feel that what I've done tonight aids my judgment and reinforces the concept that Ulta is probably, for me at least, and for my club, a decent stock to consider going forward as we look to take some of our cash. We have a lot of cash in this club. We've been concerned for 5 or 6 months and have been raising cash, and we have a lot of cash to spend right now. So we're eager to do it. In fact, we put a committee together for the first time in the last 12 years, and the committee's job will be to kind of hold the reins on the club and prevent it from doing anything rash in a short amount of time. This club has a tendency sometimes to take off and run with the buggy, and we want the wheels to stay on the buggy, so we're gonna take a set of reins and pull back just a little tiny bit, push back on some of the things that we're talking about. Mark, I'll turn it back over to you and to your screen, okay?
Okay. Yeah, and while Ken's doing that, I mean, obviously there's concerns about the number of stores that are open. I don't know if they have any stores open. Do they still have some online?
They have a significant online presence, Mark. They do a lot of online business. That's become a significant part of their business. But they only have stores open in a well, I don't even know if they have any stores open. I won't even say that. Yeah. I don't think they have any stores open.
I think a lot of the analyst assumptions right now are basically assuming that there's very little retail activity, and I think it's kind of a worst case scenario in some of the cases. One of the things I would point out is we did a quick study of Middleby, the industrial kitchen company, and we discovered that Value Line has very negative, very pessimistic expectations for the next year. compared to the analyst consensus, but when you look out over a 3 to 5 year time frame, they actually kind of end up in the same place. And that's kind of an interesting phenomenon too to end up with.
Mark, I want to answer one of the questions
Yeah,
out loud because I think it will help everybody, okay?
Go for it.
Shirley says, what do you think of the 50% debt in this company? And Shirley, I want you to know that this company has no more debt in 2020 than it did in any of the last 14 years. In the last 14 years, the data has shown zero debt. In 2020, that debt number has suddenly come to 50%. That has nothing to do with the company suddenly borrowing money and assuming debt. What it has to do with is a change in the general accounting practice rules. The rules now state that you must include leases as part of your debt. So if you've leased a store, and you will find that many retailers lease most of the stores that they do business in, if you've leased the store, then that lease, what you owe on that lease, is part of your debt load. Now, we've never considered that as debt on a company before. We've always considered that an expense of doing business, paying your rent. But the accounting rules have changed, and suddenly in the data that you're receiving, you'll see for Ulta and for so many retailers and restaurants across the scope, you'll see their debt increasing because of this lease. We did a ticker talk on this. We're going to do another ticker talk on this coming up in the next couple of months. I would urge you to go to the Ticker Talk archives and look for the discussion that we had about 3 or 4 months ago about debt rules and changing debt rules, because you can certainly make a big mistake by assuming this 50% debt is because the company suddenly has done something out of the ordinary. It has done nothing different from what it's done in the last 10 or 12 or 14 years.
Yes, the accountant's making life interesting again, huh?
Uh-huh.
All right, let's talk toilet paper, but not for very long. I just wanted to talk about and the people who make toilet paper just wink and giggle when they talk about the hoarding. The shelves in your grocery store or your Costco or whatever will eventually catch up, and the people who make toilet paper know that they just continue making about the same amount all the time. And it's called, this is an example of a defensive stock. The demand for toilet paper is a relative constant. It's just the reality. Clorox, that's also a relative constant. There has been a little more Clorox usage. My hands are a little bit more tender here lately. But I wanted just for a moment about this notion of defensive stocks, just as a quick warning. A defensive stock is that stock that's got a high dividend and a high quality, and you can buy it, and there's a running for the hills defensive bandwagon out there, and you'll be protected. On the day that this price spike happened, over a period of 3 or 4 days, some of the major investment banking institutions were issuing strong buys on Clorox. And I feel kind of bad for the people that got stranded at $215, because it might take a while to earn a return on that $215 stock. And here's what the stock selection guide looked like on that day. Basically talking about a company, very steady growth, very steady earnings. The growth rate is 2.5%. The projected net margin is somewhere in the low teens, perhaps 12%. The PE is somewhere in the 18 to 20 range. Under that set of assumptions, we're talking about a stock with a -8 projected return when the stock price was at 215. None of us here tonight would buy that stock. And based on the low price and the long-term return, you're looking at -13. So again, that's not what I would call defensive. Well, you always have to check. You always check. Ken and I just have some thoughts from 35,000 feet. This is the one that I kind of go to when they were going through the handout of the $2.2 trillion. Seems like a heck of a lot of money. What I want to point out to everybody here in the audience is it basically moves this graph from here to here. It's basically still in that blue band over the years. I'm not happy that that we're going more into debt at the federal level, but I don't think it's a mountain to die on. Is that pretty much your perspective too, Ken?
I agree, Mark, that the GDP has handled this type of debt before. I think it's historically on the high side, but I think that we must do what they didn't do in the 30s, and that was to find ways to make it so that the average person and the poorest among us could survive that severe economic downturn at that point. Of course, they had many more months to play around with the whole thing, but they never really went to solutions to the problems as far as I'm concerned. I think that when I look back 30 days and I say to myself, 30 days ago, a lot of these Federal Reserve programs didn't exist. 30 days ago, a lot of this aid to the general population didn't exist. And then I say to myself, I wouldn't have bet a dollar that Congress could have done something in such a short amount of time. I wouldn't have bet $3 that the Federal Reserve was going to try to stay ahead of this problem. And yet it seems that both these major institutions have been able to stay ahead of this problem. I liken it to a spring that's kind of all being compressed with all kinds of pent up kinetic energy. It becomes potential. And when the problem, whatever it is, becomes a problem no longer, that potential energy has the ability to change into kinetic energy in a very, very fast, quick way. I've begun to hear glimmers of that on the talking heads, even on television, that are indicating that it's not going to take a lot of good news, good, truthful news. It's not going to take a lot of that truthful news to push people. Remember, the market's a forward-looking institution, and if we get some good news out there in the next 2 or 3 weeks, I think there's a real potential for that pent-up energy to suddenly be released and for us to see things happening. Maybe the last 2 weeks in the stock market have been a glimmer of what might be happening. I don't know if we're going to go backwards and retest some of those lows around the March 22nd, 23rd, 24th, but I do know that we've put an awful lot of fixes that are helpful to the economy, and we've put them into play. It might take a week or two or a month for that money to work its way through the system. But I think all these things, once we see some glimmers of hope, are going to help us move out of this problem in a fairly quick manner. Now, whether or not our behaviors follow some of that pent-up demand, that's an issue for another day. I know that I'm ready to go back to the theater whenever the theater reopens. I know that I'm ready to even maybe take in a ball game. And Mark knows that that's not one of my most favorite things in the world to do. But Natalie and I can't wait to get back into a good restaurant and have somebody else wait on us for a change. So with that, I'll shut up, Mark.
Well, yeah, I agree with all that. I think that the size of, again, I'm not comfortable with more debt. That doesn't thrill me, but the size of what they're doing, it's not as big when you start comparing it on a scale like this. The other thing that I find interesting is that the amount of buffering that this aid is giving to small business and individuals through some of the loan packages and stuff that they're putting out basically buffers for about 10 to 12 weeks. So that gives you some clue of what they think might be involved with the situation we're in. The other thing that Ken and I talked about a little bit, we won't go too deep into it, but some of the discussion about infrastructure. Could we be looking at an intelligent program executed well that would do some of the things with roads and parks and infrastructure that we did back in the 1930s? Who knows? But it's an interesting thought about, could that be part of this healing process? One quick slide just to make the point. I don't want to make too controversial a point other than to point out that a lot of the data and a lot of the information out there is very disruptive, very disrupted, very dislocated, and that's got a lot to do with the problem of the volatility in the stock market. This is looking at pneumonia deaths year after year for the last 8 years. The red one is the current year. And I think some of the pneumonia deaths are being counted elsewhere. And it's just an example of how dislocated and disrupted some of the data and information is these days. And if you look at the total death screen, it's even more intriguing in terms of the disruption that's going on. All right. So with that, as Ken was saying, and we kind of have come back full circle, are we in that 2008 moment down where the relative strength index is kind of bottomed out around 30 a little bit? We're in this zone of kind of stuck towards an area where maybe we can't see where the good news will propel us forward. So it is time to go shopping for good companies at good prices, but it's always time to do that. Here's a quick look at a quick screen of companies that qualify with a manifest rank of 98 or above. That means they are companies of high quality and fairly decent return forecast. And you see that in the two columns shown here. And I've thrown one other constraint on here that Ken and I wanted to highlight tonight, because if the recession is truly imminent, we should be thinking about smaller companies, beginning our shopping efforts. Again, when there may be some pain left in this equation, but it is time to search for the faster growing companies. I limited the growth rate to a minimum of 12% for this list, and you see it here. So again, a lot of the companies, Yeti, cooler companies on there, Five Below, that was presented this month at the roundtable, and a number of companies on this list qualify for a little bit closer look, and we probably will be looking at some of them here in the near future.
Yeah, I feel compelled, Mark, to make the point also that a stock search is exactly that. It's a search for ideas, and that when you see a list of 15 companies like you do here, you probably see a list of 6 or 7 or 8 of them that might be investable, maybe even fewer than that. Don't automatically assume that because a stock is on a list like this, that it's investable. Do your homework, do an SSG, read what's on manifest, read, and then read some more, because that's the way you're going to find companies that have a business model that's going to survive throughout whatever we're looking at into the next 4 or 5 years. You know already some industries that are having a little bit of issue. You know the cruise lines, you know the gambling casinos, you know the airlines, and you know the oil patch, the whole oil patch. Why worry about stocks like that are on sale when you can find terrific stocks in other sectors, other industries that are also on sale and that don't have some of those issues about whether or not the company will survive without the government stepping in? I urge you to become a student and make some decisions based on what you read, and don't be swayed so much by what the analysts are telling you in their dialogues, but be swayed by the numbers that they're putting together, and ask yourself, how reasonable are those numbers? And then use those numbers to do stock studies on your own. Manifest provides you the opportunity to do Eagles, that's equity analysis guides, and your SSG provides you with the same opportunity. This is a great list to start from, but it's only a starting point. Mark, I'm not going to go through every question that we have in our question box here, but I am going to highlight a couple of things that I think our audience might find interesting. James Gleason says, now's a great time for retirees to consider a Roth conversion with the stretch IRA being eliminated.
Excellent.
So as you're doing planning for your retirement, you might talk to a professional if you don't understand the differences between normal IRAs, regular IRAs, and Roth IRAs. And then you might get some advice about making that conversion in your IRA while the numbers in the IRA are much smaller than they were a month or 6 weeks ago. So James, thank you so much for that comment. It's appreciated. John Van Deercreek wants to know, will this recording be available? And yes, John, I know that it'll be on YouTube tomorrow or Wednesday. It's under the Manifest Investing Roundtable, and you can go there and you can find all of these recordings for this series and also the recordings of the roundtable. They're all there for YouTube, and you can listen to them as much as you want. I'll tell you a very small story. I thought Mark was really silly in asking us to put these on YouTube. I thought, yeah, we'll get 6 or 7 hits, you know. We actually get hundreds of hits on these things right now. So I'm really kind of proud of the whole thing, and I take my hat off to Mark for having the foresight to use YouTube. And we've been using it now for maybe 7 or 8 years, way before it became as popular as it's become today. Go on, Mark, what were you going to say?
Well, one, I was going to mention that this is the view from the other side of the bridge.
Oh, all right.
The other thing I was going to mention is I noticed some people in the comments that complained about sound quality. So if sound quality is an issue, we might have to do an encore presentation. We'll see.
Okay.
Part of the reason for that is that we're battling for bandwidth, and with Zoom and everything out there, I'm actually hardwired tonight. I'm connected to our internet, and but there's plenty of load apparently on the internet. So that can be an issue. That's why some of you are reporting distorted or muffled sound.
Yeah, I've noticed that you broke up occasionally. It wasn't enough so we didn't understand you, but at various times the quality did deteriorate a little bit, Mark. Ann Manning wants to know, Mark, are you getting a lot of your data right out of the value line issues? And the answer is absolutely yes. That's where a lot of the value line numbers come right out of the value line issues.
Right, but the forward-looking analyst, the analyst consensus numbers are coming from Y charts. So those are the ones that are updating a lot. So the estimates for 2020, 2021, and 2022, those are consensus estimates. Still got you, Ken?
We're still here, Mark, and I'm reading a number of other things. I think that we've covered. Mark, Frank Wilson has a number of questions about Manifest itself. I'm suggesting that maybe you and he have a sidebar at some point in the next couple of days. I hope Frank's in a place where he's sheltering at home, and I know you are, and maybe you could answer some of his questions about his Manifest subscription, okay?
You bet. In fact, I've been thinking about, we have a Zoom account also, and I've been thinking about holding a session on perhaps Thursday afternoon. Bandwidth and pipes permitting, but to give people an opportunity to check in, and perhaps we can answer some of those type of questions. And perhaps
Okay.
Saturday morning also.
Okay, Mark, I think I've covered a lot of the questions that kind of pertain to some of the more general things that we did right here. Folks, I appreciate your faith in Mark and I as sounding boards, but some of these questions that you've asked us, I just don't think we can answer in 8 or 10 seconds. So,
Well, we'll take a look at the list, and we can post the Q&A in our forum also.
okay, Mark will try to do some of that, and maybe he and I can split some of these and try to get some of the stuff going at that point. We did say we were going to try to aim at somewhere between 8:30 and 8:45, and I'm showing 8:45 right now, so we're going to call it an evening. We appreciate being able to draw an audience on an odd Monday night like this. Thank you for coming, Mark. As forever, thank you for all the work you do and for putting most of these slides together tonight. It was a pretty good session from my point of view, and I hope that you folks in the audience agree. Thank you for coming, folks. Good night.
Good night, everybody. See you again soon.